this major kind of cycle doesn't really end until there's major, like massive currency devaluation among the largest currencies in the world. Basically, major debt devaluation, major currency devaluation, along with more durable, kind of just shift in public perception uh, away from this highly polarized environment. Which I don't think that happens in the 2020s.
Hey everyone, my name is Anthony Fatsies and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Lyn Alden. So Lyn is one of the foremost macro strategists, founder of Lyn Alden Investment Strategy, and also the author of a very good book, Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. So Lyn, thanks so much for coming back on the podcast.
Thanks for having me back. Happy to be here.
Yeah, looking forward to the conversation. And yeah, it seems like every sort of month, I'm sure everything that you said in the book, it's slowly coming true. But yeah, if we maybe go back to 2025, how do you look at 2025? What are the key things that stood out for you?
I think primarily we shifted to a headline-driven market. So 2023 and 2024 were mostly characterized by kind of single direction markets, meaning that they were kind of very much liquidity-driven. By judging the current state of things, you could generally forecast pretty accurately how things were likely to go for the next couple quarters. And in 2025, just because the political and the geopolitical environment has been much more volatile, it's much more headline-driven. Basically, political decisions can impact markets more than just pure liquidity, even though liquidity is still a big factor that happens along the way. And so it's certainly a lot more, a lot more to write about and talk about in 2025. And that's kind of been the main thing is that geopolitics is kind of back front and center. There's these kind of big macro things to kind of deal with, but it's really all still part of the same theme I've been talking about for years. Basically, fiscal dominance. When you have fiscal dominance, these sort of extremes tend to happen more frequently. And we can learn a lot from history. We can learn a lot from multiple other countries, and how they've kind of gotten through situations like this. But that's kind of the main thing so far is that this past approximately a year has been a much more headline-driven market, meaning you can get kind of hit with random things rather than a more kind of slow unfolding situation that we had for about 2 years.
Yeah, and it has seemed to be very frothy in terms of, some days these massive trillion-dollar companies can go down by, 10, 20%, as you said, based on these headlines. So is that just sort of the end of a bull cycle? Do you think this is a shift to this headline-driven environment, maybe for the near term and probably for Trump's presidency?
I don't think it's like a natural end to a bull cycle, meaning it's not like a bull cycle just kind of naturally exhausted itself and started happening. It's really just more of a political shift. I mean, basically, tariffs are a massive wild card. Potential for military intervention at certain points is a wild card that can sometimes affect energy markets. It's probably contributed to the run we've seen in precious metals, not the only factor. And so it's more of this kind of like that shift in political environment. That's really kind of changed the structure of what otherwise was mostly liquidity driven type of dynamics. And then we still have the underlying liquidity stuff. So we shifted from quantitative tightening to quantitative easing. And that got a lot of headlines, but that was pretty much forecastable ahead of time. So even the Fed roughly predicted when that would happen. In my research, we were talking about roughly when that would happen, whether it's kind of the last quarter of 2025 or kind of the early part of 2026. There's a range where it could have happened. So a lot, that kind of background financial plumbing stuff. Nothing particularly shocking there. That's still mostly predictable. And then it's more just this headline overlay, which I wouldn't really say is just like that natural result of a bull market. It's just more of a political shift. But then of course we also have that technology shift. So the kind of the rapid, consumer and business usage of AI has, for example, eaten into some software companies, and of course has contributed to major bull runs elsewhere. We have kind of fluctuating currency markets. Like, that's partially tied to some of the geopolitical stuff we're seeing, some of the kind of the drama around the Fed and other central banks. And so there's this kind of pretty chaotic field out there, which is good opportunity for traders or for those that are kind of, you can never be fully prepared for all the stuff that happens. I mean, if someone just kind of listed all the things that happened, let alone at the start of 2026, but all throughout 2025 and so far in 2026, it's probably way more than they would have guessed. But all that is from a pure investment standpoint, generally opportunity. Volatility is basically gives you entry points, exit points. People get distracted by X, Y, and Z over here. So if an investor can kind of look and say, okay, what are people missing? What is actually cheap? What is like the next year's headline? Let's get in now. So still lots of opportunity.
Yeah, definitely. And I guess you mentioned the Fed, and there is this uh, DOJ challenge, I guess at least that we expect to potentially happen. And what does that mean? So is this just Trump trying to sort of pull the Fed into line, and then maybe set the path to what the next chairman will have to deal with, or how do you view this?
Well, so as soon as that happened, actually, like poly market, like betting market odds, actually, if anything, started pricing that Powell has a greater chance of staying in beyond when his chairmanship ends. Because his chairmanship ends, before his governorship ends, and the assumption is that when his chairmanship ends, he would step down as governor as well. Um, but the betting market's thinking, well, now he might be mad, maybe he won't now. So I'm not sure that's it's kind of working. Um, I think on we've already seen kind of a somewhat of a distancing from it. So the announcement itself was rather shocking because generally speaking, central bankers kind of talk in circles. They don't really come out with like fiery stuff. Whereas that was more scorched earth. I mean, Powell just came out and said this isn't about renovations; it's about Fed independence, which is just like a direct counter. Um, it's definitely the biggest kind of executive branch and Fed kind of conflict since the 70s, and arguably ever since 1951, the Treasury Fed Accord. So we certainly live in interesting times as far as that goes. Since then, Trump has somewhat distanced himself from uh, kind of indictment talk, saying that he wasn't really aware of it. He hasn't really doubled down in a way that is more common with him. Some news reports suggested that those around him were somewhat surprised by it, that it goes against what Treasury Secretary Scott Bessent has been kind of orchestrating for many months. He's trying to kind of orchestrate a orderly transition toward a more Trump-driven Fed, rather than one that's kind of spooks the market around Fed independence as much as this. So my base case is it will cool off, and that Powell will finish his term as chairman. But it's certainly a lot to talk about. And so it's another headline that spooked markets. I mean, metals moved pretty rapidly, and the dollar had a little shift right on the headline. But since then, I think there has been de-escalation because I think there's enough people that are worried that further escalation there would spook markets.
Yeah, definitely. And I guess that will then lead into, as you said, that transition, and hopefully I guess a positive transition, and one that's there's less challenge. But how do you see? I don't know if you have any thoughts on potentially next Fed chair, and do you see them going the way Trump wants to go with these massive cuts, potentially QE, massive injections of liquidity, or do you think they'll be a bit more careful about not losing control of the bond market?
Well, I mean, so far the interesting thing is that because of some of Trump's recent remarks, the betting markets are actually leaning toward the more hawkish pick of some of the recent options, which is interesting. My base case is that basically this year he will, he'll get a new. I don't know who the Fed chairman is going to be, but he'll get a Fed chairman that is generally probably more in line with his outlook on things. There will be a general uh, gradual dovishness inserted into the Fed, with the switch of the chairman being kind of the biggest individual moment. It's already started to some extent. We already see more Fed FOMC members disagreeing when it comes to FOMC meetings instead of everyone kind of voting the same way. You have some people kind of pairing off of that and saying, we disagree with the majority position by 25 or 50 basis points. I think that kind of thing will continue. Um, in the next year or two, I don't really see like major wholesale changes in the Fed in the sense that they just completely throw out their playbook. I think that they're still going to try to project a sense of independence, a sense of being data driven. Um, I think that they markets might or may not fully believe that in a way that they somewhat have under Powell's term. Um, but I think it's going to be more of a transition. I don't think it'll be like some massive just black and white change. I think that it's gradually over time, which happens in fiscal dominance. It becomes generally less independent in a realistic sense. And then the question is, does it ever get to a significant enough degree that the bond market gets totally spooked? So far, no. I think in the look far enough in the future, I think that's likely. But in the near term, they still have plenty of levers to pull. And liquidity speaking, I've been in the camp that they're going to do a gradual print, which is to say that they're going to shift from balance sheet reduction to balance sheet increases. Um, but that the increases won't be like COVID level type of, just balance sheet going vertical. And instead, it'll just be a more persistent, prolonged, but kind of magnitude constrained injection of liquidity. That's so far what Powell has projected through tax season. They've kind of projected that through April and May, they'll be adding liquidity. We'll see what happens after that. That'll be a new Fed chair. So we'll see what their expectations are. The New York Fed already basically projected, as far as that I can see, mild liquidity injections. They've been projecting that for about 2 years to start roughly around now, and I think that's roughly my base case that we go back to a more gradually expanding Fed balance sheet, uh, gradually expanding broad money supply, which is this ongoing persistent debasement backdrop, uh, alongside everything else that's happening.
Yeah, okay, really interesting. But it does sound like that means, yeah, run it hot, probably good for markets, probably just going to continue to see, I guess, what we've seen the last few years uh, from a market's perspective. Just everything goes up, probably except for potentially bonds. Is that what you
Yeah,
see?
more or less. I mean, when I refer to run hot, it's mostly the fiscal side and the monetary side. So basically, kind of the order of operations there is that regardless of what inflation's doing, whether it's above target or if they get it below target, if the treasury market becomes illiquid or otherwise breaks, or if the repo market becomes illiquid or otherwise breaks, basically the overnight lending market between financial institutions, when those things break, those are like core parts of the system. So the Fed will jump in, right away. And for some of those, they already have standing facilities like prematurely jump in, let alone take bigger action. So that's kind of the run a hot environment, basically. And one of the challenging things is like the New York Fed is projecting that they're going to roughly keep their balance sheet flat as a percentage of GDP. The issue there is that the large fiscal deficits contribute to nominal GDP, which basically means that the bigger the ongoing fiscal deficit is, the faster the Fed balance sheet will rise. They kind of cede some of that control, without saying so, over to the executive side. Um, and they try to mitigate it where they can. I mean, their current balance sheet expansion is limited to, off the top of my head, I think 3-year durations or less, for the treasuries. So T bills and shorter duration T notes. That could expand over time, but they're not really targeting duration here. They're not really doing it for the purposes of economic stimulation. They're doing it for basically financial plumbing and bank reserves and keeping the monetary base going up so that banks stay liquid and keep making loans. So you get that ever growing broad money supply, ever growing base money supply. That doesn't necessarily guarantee that almost all assets go up. If stocks get overvalued enough, they can certainly have like a 5-year period of going sideways to down while money supply is still going up by 5, 6, 7% a year, while the monetary base is increasing. There's really nothing stopping, say, the market going from, say, it's averaged at 40 times cyclical earnings to 30 times cyclical earnings. That kind of contraction can still happen for a number of years. So valuation still matters. Certain investments can certainly do better than others based on growth, based on starting valuations. But generally speaking, yeah, when you have a rising monetary base and a rising broad money supply, that's mostly not tied to cyclicalities. It's not really driven by bank lending cycles. It's more driven by persistent fiscal deficits that are partially monetized. That's a debasing background that is up against some other forces, but the general bias is up and to the right.
Yeah, it makes a lot of sense. Like, as you mentioned there, the debasement trade, we have this deficit, which doesn't look like it's gonna go down unless, maybe interest rate if interest payments come down, it might go down a little bit, but that seems to be the only only way. But do you see if they continue to grow where they are, and this is, the GDP growth is inflation adjusted. So if you take out the inflation is actually higher, could they actually get to the point where they are slowly outgrowing the growth if they keep the deficit where it is? Or do you not see that as a possibility because there's potentially more liabilities coming up in the future?
Well, that's kind of what they've been doing since 2020. I mean, debt as a percentage of GDP, public debt reached a peak in like 2020, 2021. Ever since then, you had a rebound in nominal GDP. When you look at, for example, like Argentina, when they, on their when they were, especially a couple years ago, when they're on their massive kind of like, you know, budget deficits were going crazy and money supply was going crazy. The budget percentage as a percentage of that year's GDP was actually not that high. Uh, Instead, it was really high compared to last year's GDP because the nominal GDP and the inflation growth was so huge. And so my general view is that it's not that that number is going to keep increasing too much, debt as a percentage of GDP, that they somewhat can run nominal GDP and money supply as kind of fast as debt growth. That's not really the main constraint. It's what are the consequences of doing that, right? So you have right now consumer sentiment is near record lows, despite the fact that stocks are roughly all-time highs. It's kind of the biggest divide between those kind of metrics in like 40 plus years. Um, and so there's kind of this like quiet, slow motion cost of living crisis. Some people have called it a K-shaped economy. Some people call it a two-speed economy. Different kind of terms out there. But basically, those that are not on the receiving side of fiscal deficits, so mostly that's interest expense, defense, Social Security, Medicare. That's where a lot of that deficit spending is going. There's obviously smaller pockets as well, but those are the really big kind of pie chart components. Those on the receiving side of those are generally doing pretty well. If someone's really not on the receiving side of those, but they're on the wrong side of monetary tightening. So let's say they're a young family looking to buy a home, we have pretty high mortgage rates, pretty high, house prices. That's why we have a very high average age of buying a home these days because generally speaking, lower and middle income and younger families on average are kind of mostly locked out of that. They're not really on the receiving side of the deficits, but they are on the wrong side of the interest rates that are trying to contain the inflation. People are generally seeing that their money's not going as far for groceries or health insurance, things like that. And so you get rising populism. That's a topic I've been focusing on for many years. That you get kind of first you get kind of like reasonable types of populism, and then when those just go unaddressed, you get more extreme types of populism. Um, and that kind of just keeps churning and churning and churning. So they, 5 years from now, they can say, look, the debt to GDP is still roughly the same. Um, but everyone's like, well, my salary didn't keep up with, money supply growth, and I don't feel more well off than I did 5 years ago. And so you get just rising social unrest, and it comes out on the right, it comes out on the left, it comes out in multiple different ways, and that's more the actual cost rather than just that pure debt to GDP metric.
Yeah, okay, that makes sense. But it sounds like you think that inflation is probably going to be a little bit higher than what we saw in the 2010s, which has sort of allowed it to happen, I guess, because when you have the lower inflation, you can let it run hot and these things explode. But now, if we
I
have inflation,
yeah,
yeah,
I think on average, but I think it's very specific. So generally speaking, it's hard to get a really super broad inflation without energy inflation, which right now we don't have. All the major inflationary cycles of history came with a pretty big dose of energy inflation. Um, and right now there's deflationary forces on technology. So, AI and things like that are kind of putting downward forces on certain services just because they make them just, cheaper and automatable. You still have pretty significant inflation on things that are labor intensive, capital intensive, hard to reproduce. That's where you generally have inflation showing up. Where I'd be worried about a higher uptick in inflation is once you get some sort of energy inflation. So right now, under current prices, U.S. shale oil is generally not drilling a ton, and they have pretty high decline rates. So we don't really see it rolling over yet, but we see some of the precursors kind of flattening out and looking like they might roll over. And so you get kind of like weaker, marginal production. And if that goes on for a number of years, you get shortages, and then you get another spike in energy prices. Some of what we saw in recent years. That's where you get probably higher inflation. Um, in addition, if some of the AI, uh, benefits don't come as quickly as some of the bulls think, then they're not significant enough to offset inflationary kind of policies elsewhere. Uh, then any sort of like social disarray tends to be inflationary. So like if you have one society that is like like let's say Japan for example, if you does have a society that most people just clean up after themselves, there's pretty low violent crime, there's pretty low just mayhem. You don't need to put a lot of resources into like literally or metaphorically putting out fires. Whereas when you have a economy or a culture that's otherwise just more disarray, there's more violent crime, there's more protests, there's more just polarization. You're putting more societal resources toward putting out literal or metaphorical fires all over the place. That's inflationary. That's basically it's kind of like war. War is you spend resources to blow other resources up, and so it tends to be inflationary. Whereas in times of peace or in times of kind of social harmony, most of the resources can go toward innovation, making things better. Organization is generally disinflationary, and so we have that kind of mayhem premium. I think that's kind of just gradually put in the United States and Europe and in a handful of pretty large places around the world.
Yeah, so as you say, this sort of chaos is yeah, potentially could lead to very negative consequences in the future. Do you see a way around this? Because it does seem like the more entrenched the current system gets, the more, I guess, wealth divide there is between, the K economy, the greater that becomes, the more instability there is, the more extremism there is. Do you see a way to prevent that? Are you sort of positive on this? Are you negative on this?
I mean, I would say pretty negative on it. I think it gets worse before it gets better. I think that the world in general has to kind of get past the demographics hump. We kind of built all our systems assuming that population always goes up and that the next generation is always bigger than the prior one. But as we have kind of the ending of that kind of cycle, we have a very, around the world, we have very top heavy entitlement systems that's contributing to a lot of the polarization where people kind of feel the social contract breaking down around them, more intergenerational conflict. Uh, you know, and then that's where it gets very political. I mean, some economies then say, well, let's have a lot of immigration to fix that, and then you get the pushback against that in both Europe and the United States. So that becomes a more of a political crisis, and a lot of that has to be worked through, and I think it's going to take a very long time. And then the pendulum kind of swings back and forth really far and gets kind of more extreme each time. And so I don't really see a clean fix anytime in the next like an investable time horizon, 3, 5, 7 years. I think the best people can do is focus on themselves and their own communities and just try to be just, try to make their lives and the lives around themselves better than when they woke up that morning, and better than, the start of the year and better than the start of the decade, and just kind of, keep their own garden in order.
Yeah, really interesting. And how do you see, I guess, the immigration impact? Because there's this, I guess, there's a theory saying that when you have especially these large immigration levels that we've seen in the past few years, that could then reduce, increase supply, reduce potential negotiating power that employees have, and reduce wages, which potentially could make this issue worse. I don't know if you agree with that scenario, or if you think there's another perspective on that. And I guess, yeah.
Yeah, all else being equal, it's a downward. I mean, that's why corporations and certain governments like it, is because it puts downward pressure on wages. I mean, there's multiple different types of immigration. I mean, there's skilled immigration, there's unskilled immigration, um, multiple different kind of factors there. But generally speaking, it contributes to higher nominal growth because you have that more population growth, but it doesn't necessarily contribute to per capita growth. Canada was a pretty significant example of that because their kind of real GDP has been at like stall speed. They had multiple years of above target immigration, but the per capita metrics were pretty dismal. And so that that happens. Now the United States has big other factors. We have we're suffering from Triffin dilemma. So there's kind of multiple competing things all going on at once. Um, so it's a much bigger topic than just do you have this kind of valve that can kind of lower wages or not? I mean, there's at any given time, there's pros and cons to immigration. It depends on what kind of immigration. Then there's the whole legal versus illegal immigration, skilled versus unskilled, the sheer numbers involved. I think that pretty much by anyone's estimation in the Western world, the immigration levels have been extraordinarily high until pretty recently. That's been I would say a destabilizing force because there's more downsides to that than upsides, and that does contribute to the polarization we see today. Um, I think that as governments kind of more clamp down on immigration, as it's become less popular over time, and as there's been kind of pushback against it, it can put some upward pressure on wages. But I think that also AI is going to kind of push down wages to some extent. Over the past several decades, automation in general has been um, a downward force on blue collar work in many cases, like factory work. It's not all. I mean, it's a good it's a net benefit to society because basically what it does, kind of like how go all the way back to the tractor. When they invented the tractor, and it's one farmer do the work of 10 farmers, and that's a good thing. Now in the near term, it means 9 farmers might have to them and their kids might have to go work somewhere else. Generally speaking, higher wages and contribute to building stuff and medicine and other things. So instead of having 60% of society having to work to feed all of society, you have like 2% of society can feed everyone. And then that started to happen to manufacturing. So instead of having a really big chunk of society employed making stuff, we'd basically you have skilled manufacturing oversight. You have a lot of robots doing it, people around to kind of troubleshoot and fix the robots, and kind of handle the skilled parts. And I think that to some extent, that's going to, I'm not the first to say this, obviously, it's kind of understood that's going to happen to some percentage of white collar work. That some of the more repetitious types of things can be automated, which, doesn't fully displace jobs. It kind of just means that one accountant can do the work of two accountants, three accountants, five accountants, depends on how efficient that those systems get, and that more things that were that used to be very labor intensive can be automated, which in the near term can be disruptive. But in general, it's an ongoing march toward the gradual cheapening of many types of labor, and generally to the benefit of capital. And then it becomes political because then you have people trying to take that capital and spread it out again. People trying to stop that from happening, so you get that conflict either at the government level, the state level, the corporate level, and it contributes to chaos.
Yeah, it's really interesting. And I guess one thing I have a perspective on, and I don't know if, maybe this is a negative way of looking at it, is that actually if you have an older population, it might be better during this transition because lots of young people unemployed creates uncertainty and potential chaos and this backlash. I don't know if you've thought about that at all.
I have. I've seen Luke Gromen make that point about China, that China has this big demographics cliff, and he said, "Well, if we have AI coming and we're worried about displacing jobs, do you want a young and rapidly growing population, or do you want a shrinking population? Because then you have, if anything, you have less of that issue." I mean, that partially depends on how quickly AI displaces jobs, what kind of jobs it displaces. But generally speaking, productivity growth is one of the major levers to pull against these demographic cliffs. So when you have at the extreme end, when you have a demographics cliff looks like Japan or Korea or China, uh, automation and just advanced productivity can mitigate that. So you're still providing the goods and services that people need, even as there's fewer people available to work hard and provide them because they're older and over time fewer of them, and you have a more top heavy entitlement system. And that's eventually going to that's spreading into Europe. It's spreading into North America as well. So AI and technology in general is the best medicine we have against kind of the demographic bulge that the world's most of the world's going to go through. Which one wins, I think, is challenging because then it becomes a societal issue. If most of the gains is that it just kind of concentrate significantly, you get more and more polarization, and it gets redirected in different ways, but it just kind of keeps building, and the outcomes are not always at the thing that's actually causing it. It just kind of spills over multiple places. So different societies will handle that better or worse than others. I mean, generally speaking, Japan has a more harmonious way of handling it, so they've been able to really kind of push that further than most others. Um, whereas many other places, they start to run into big cracks well before then.
Yeah, really interesting. So I guess we go, another trend at the moment, as you said, it's the headlines, but it's the geopolitics and how that's potentially shaping the world and what we're seeing. So a big theme at the moment is obviously Greenland and the potential for the US to either buy or take Greenland. Do you have any? I don't know if you thought about the realism or how realistic that is, and I guess there's an understanding of why they want to do it, but do you see something like that occurring?
Well, I mean, we already have the option. They've already provided the option to have more military sites on Greenland if you want missile defense and stuff. So the reasoning for this shifts around a lot. I mean, a NATO invasion of a NATO controlled territory would certainly be, I mean, like no shortage of headlines this year. That'd be probably the biggest one. My base case is not shooting war on Greenland in 2026, but then again, if you asked me in 2025, I would have given a 0% chance roughly of that happening in 2026. Now I'd say it's not zero. So it wouldn't be my base case, but I wouldn't be utterly shocked. Um, and this whole thing, I mean, I've been on your show before. We've talked about precious metals and things like that. I mean, these kind of environments are why owning bearer assets is helpful, because you have this kind of potential for mayhem around the world in multiple spots. It's not always the spot people thought it would be. But, the Venezuela, Iran, the Middle East in general. Um, these are kind of the Taiwan. These are kind of the hot spots that people are worried about. Now, Greenland wasn't really high on people's list until recent times. Um, but when you have multiple countries in the world going through fiscal dominance, going through very real crises, they have a pretty strong incentive to direct attention elsewhere and to blame someone else for issues that they've built up. Um, and you'll have multiple sides doing that at the same time, and I think that's the core of it. Like, I'm sure if I come on again, we'll be talking about a whole nother set of headlines here. Some of these might have played out, some of them might not have played out. Be a whole nother kind of set of chaotic headlines. But the underlying factor is that the rot for this has been building for years and decades. The rot of Triffin dilemma and kind of the hollowing out that happens when you have the reserve currency. That's a really big one. Then there's just the fact that the unipolar world's kind of shifting into a multipolar world over time, or if anything, it's shifting back to a multipolar world as it was for most of its history. And that's a challenging transition. Then you have that whole global demographics bulge. Pretty much everywhere outside of like India and Africa, you've got these top heavy slowing population countries that built all their insurance, like their sovereign insurance, their entitlement systems around the idea that those just grow forever. Um, and so that's a massive issue. And so as that those all kind of that slow motion like car crashes are playing out, there's this incentive to distract, blame elsewhere, and that's where things get very dangerous and harder to predict. And that's why fiscal dominant periods are often associated with more wars. I mean, wars contribute to fiscal dominance, and fiscal dominance contributes to war in a vicious cycle until a crescendo happens and the dust settles. Um, and so I think there'll be more of this before there's less of it.
Okay, yeah, it's really interesting to see how the world's shaping, as you're saying, and it's all driven by that fiscal dominance and all these other complex. And I think sometimes that's what I think. I don't know if politicians struggle to see it, or maybe they just don't communicate it very well. How all of these trends are coming to play, and they sort of try to find the first order thinking of what's causing it, whereas it's the second order and all the other trends that are driving it.
That contributes to a lot of these issues that they had they solved one problem with all this entitlement systems, but then they don't project it out far enough. Then they say, okay, wow, the entitlement systems are really top heavy. What can we do? well, let's loosen immigration. Let's lower our demographics age and increase our population through immigration. And then like, oh wait, that causes a pretty obvious social crisis when you do that at scale. And then you try to put out that fire, and then you have countries saying, well, people complaining all the time on social media. Let's go out and try to like ban social media. It's like you're always putting out one fire and then creating the next set of fire. And what it does is, I mean, there's this gradual reduction in trust that people have toward institutions, whether it's media, whether it's big corporations, whether it's government, just this gradual decline. And generally speaking, that's the fourth turning analysis and kind of cyclical analysis of history. Sometimes it's kind of categorized as woo woo, but basically there is this sense where one era kind of builds these institutions, they solve problems of the day. Over the longer time, they gradually they kind of succumb to bureaucratic entropy. They're no longer serving, they're serving the thing that they did decades ago. They're getting more corrupt over time. Multiple generations pass, and people don't trust them anymore, and they kind of just gradually or sometimes quickly break. And it's up to that next generation to build a new set of institutions, a new set of cultural norms, a new set of things to replace the stuff from a long time ago, either because technology changed or multiple other factors changed. Um, and I think right now we're still going through that dying process. These extremely low confidence institutions, but that still have very entrenched power and very entrenched network effects, are basically just slowly and occasionally quickly, but mostly slowly melting all around us. And a lot of the decisions are kind of coming home to roost in the form of rising populism. And then it comes down to who can kind of stick the landing, who can kind of replace the system, replace the prior institutions with new ones that make sense with the least chaos possible. And so for example, in the last period, in the 40s, really that was the United States. Basically there were multiple places that had utter chaos, and as the dust settled, some of them went through more extreme chaos than others. And those that managed to contain the chaos generally come out stronger in the next cycle. So the question is who can kind of do the most reasonable cycle versus letting things kind of burn fully down before they fix things.
Yeah, and then I guess do you see like a Malay who in Argentina? Do you see that as someone who's I guess creating new institutions, or is he just trying to utilize what he currently has and just extend this current process? Or is there anywhere else that you see who's or any other country that you see potentially doing this?
I generally think it takes a lot of times it takes multiple tries to do something, which is to say that's more of a shock and awe attempt. It kind of wakes people up. And generally speaking, what happens is the pendulum shifts really far to one direction. So then people shift it really far in another direction. And this is generally a process. It rarely gets right the first time. And I mean, their money supply is still growing very quickly. For example, there's many issues, but those sort of structural rots aren't really fixed in one presidential term. And one of the challenging things is that the public at scale has to kind of durably buy into an idea. Um, and that's probably the hardest part overall, is that a pretty significant bulk of society, that they have to get past that highly polarized phase and toward a direction that is more sustainable, and that some kind of significant majority have a durable kind of view toward, which is in many countries pretty rare.
Yeah, definitely. I guess someone like Argentina, it's just been bad for so long that you almost, as you said, it's that chaos or that get it, things have to get worse before someone's willing to put up with the tough decisions to actually potentially try and make change. And who knows if that will work or if it won't.
Yeah, I mean that's what happened. I mean the same thing happened in kind of history. I mean a lot of the power structures we saw rose out of chaos. Where in history books we're like, why would people want that? It's like, well, because they had utter chaos and disillusionment. So then they pick something that seems extreme, because they see that incrementalism is failing. So then they say, well, let's try to break it and start again. And I think that this major kind of cycle doesn't really end. until there's major, like massive currency devaluation among the largest currencies in the world. Basically, major debt devaluation, major currency devaluation, along with more durable, kind of just shift in public perception uh, away from this highly polarized environment. Which I don't think that happens in the 2020s.
Yeah, and I guess who are the losers? Who holds the debt? It's the government, I guess, generally older people, institutions, pensions. How, yeah, that's the challenge. How do you
Well,
you're
the
basically
government
just
the government issues the debt. Their
yeah, true.
liabilities get devalued. It's those holding the debt. Yeah, it's generally speaking, uh, large pools of capital. On average, it's older generations now, and it depends on the country though. Like in the United States, the older generation is also the recipient of major deficit spending. So right now we're actually kind of siphoning money on average from younger generations and channeling it toward older generations on average. And that's somewhat offset by that devaluation. So for example, if young people own, Bitcoin and older people on average own more bonds, that's kind of partially offsetting over the past, 5, 10 years, some of this. But there still is the fact that there's trillions of dollars of deficit spending cumulatively flowing into that older generation, which is why it generally takes a lot longer than one would think. When they did this in, like, say, the 1940s and 50s, it ended basically by siphoning more money to those younger generations. It was kind of like wartime MMT. Um, instead of siphoning it up. I think that, and right now they're still in the siphoning up phase. Um, and I think that in Europe and the United States, I think, and Japan, I think that continues for quite a while. I think that's more of a 2030s crisis. By the time that those engines might kind of run out, it would be my guess.
Yeah, no, really interesting. So, Lynn, thanks so much for your time. We sort of covered so many different trends, so many of these headlines, and what's happening, and I guess how they could potentially impact the future. So, really appreciate it. But my last question is, what is one message you want people to take away from our conversation?
I think the message is, I mean, this is an environment where diversification is helpful. I'll say two messages. I'll say financial message. The financial message is you want to be diversified. You want to think in terms of the unthinkable. So things that are improbable, but that do happen in the course of a century. This is the type of environment where have a higher likelihood of happening. So something that you might think there's a 2% chance of happening, it could be 20% chance. So even though that's the minority, it's like if it's an extreme enough thing and it has a 20% chance of hitting, yeah, you want to plan for that. So some degree of diversification is helpful, kind of robustness over other factors. And then the other one is what I said earlier, that as these top heavy systems run into issues, it can be somewhat depressing to kind of watch these things play out. Um, but one can still do their best to kind of keep their own garden in order. They can focus on their health, they can focus on their family and friendship connections, they can focus on earning more than they're spending as best that they can. By trying to focus their time and energy toward production rather than consumption, and then channel that towards savings that are then put into assets that are scarce and productive, or scarce and defensive, um, and just try to make the world around you better, because we still live in difficult times, but there's a lot of opportunities out there for those that have some combination of fortune, but also the kind of the discipline and the energy and the patience to kind of seize those opportunities.
Yeah, perfect. That's a great message. So, Lynn, thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
So I'm at lynalden.com. I provide investment research, and also people can check out my book Broken Money on Amazon or elsewhere. Thank you.
Great. I'll put that in the description below, but thanks again for your time. Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.